So buy-to-let has been a bit of a dinner party dream when people talk about a safe bricks and mortar path to financial security. So buying a property, finding a tenant, and then watching the rent roll in is the dream. But if you're holding on to that idea, then you probably need a bit of a reality check. So investing in buy-to-let property can still be a good investment, but its attractiveness has been reduced in recent years by new tax rules, legislative changes, and higher mortgage rates. So it should be viewed as a long-term project capable of providing income and growth, not as a get-rich-quick opportunity. So I'm going to give you an overview of buy-to-lets, the sort of things you should be thinking about, the potential risks, the potential rewards, taxation, mortgage rates, and also changes to laws that you should also be aware of. So if you want to be a successful buy-to-let landlord, then you do need to understand the inherent risks. For example, there is the risk of instability, so property prices don't always go up and can fall or move sideways for long periods of time. According to the Land Registry, the average house price in the northeast of the UK, for example, back in 2008, so that was just before the financial crisis, was around £134,000. By early 2024, that average amount was roughly £150,000, which is only a 12% rise in 16 years, or less than 1% per year. So if you then factor in inflation, it means the real return in terms of house price growth in that region has actually fallen. Of course, there's huge variations within the region, and some cities have seen significant growth, but over the same period, the average house price growth in the southeast of England was 70%. Now, there are lots of nuances, and the outlook for property prices is somewhat mixed. We'll put a link in the notes of this show to our outlook for house prices, which we update regularly. But you've also got to think not just about house price growth. If you're a buy-to-let landlord, you've got to look at rental yields as well. So the current high rental yields that we have been seeing are partly due to the difficulty that first-time buyers have in securing a mortgage in order to try and get on the property ladders themselves. That situation may not last if we get changes by the government, for example, and that could lead to falling rental yields in the future. Of course, there's no guarantee of that, but it is just one of the risks you have to bear in mind. Property is also an illiquid asset, and that means that it isn't easy to get your money out of. The process of selling can take several months, potentially resulting in an overall loss if you need to offload the property during a market downturn. Furthermore, landlords must plan for void periods. So it's unrealistic to assume that 100% of the time that you will have a tenant that is paying rent. You will need to be able to finance periods where your property will potentially be empty. But it is possible to navigate all of these issues that I've just mentioned. So the most successful landlords usually start off with a professional mindset and a solid business plan. I mean, I would suggest, if you are thinking of getting into buy-to-let, then do speak to somebody who's already doing it, who can give you some really good advice. And long before you even think about looking at a property listing, you need to think about your business plan. You need to ask yourself some pretty hard questions. What is your ultimate goal? Are you chasing monthly rental income, or are you playing a bit of a long game and hoping for capital growth? How much are you willing to invest, and will you use a mortgage in order to buy your buy-to-let property or properties? And are you planning to own just one property or build a whole portfolio? The other thing you've got to think about is the ownership structure. Will it be just you buying the properties, or will you be buying it through a limited company, which is something that I mention a bit later on? And critically, what's your exit strategy for when you eventually decide to try and sell? So the answers to those questions will shape the huge amount of research that you need to carry out. If we focus a bit more on the properties, then you need to understand the locations of the potential properties you want to buy, as well as the property types that might offer the best yields. So you need to understand anything like planned infrastructure projects that could impact your investment, or maybe there's going to be a huge new housing development that could impact the need for rental property in the area. So you need to understand all of these things, and don't forget, you don't have to buy rental property in the area that you live. Now, if you talk to existing landlords and local estate agents, you may be able to find out valuable bits of information when it comes to buying or where to buy a rental property. Remember, it's important to buy with your head and not your heart. So you're not buying a home for you, you are buying a financial asset. So the question isn't, would I live there? The question is, does this property provide the best possible return for my target tenant? Another decision you need to think about is, how are you going to manage your buy-to-let? So are you going to manage them yourself, or are you going to use a letting agent? So if you manage them yourself, you're going to need reliable maintenance contacts for emergencies. If you are going to use a letting agent, then you need to understand the services that they offer, but also the full costs. On the Money to the Masses website, there's a full buy-to-let guide which we're showing on screen, which covers a whole host of other things you should think about in your research. Once you've decided on your strategy, you need to understand every single cost involved. So it's far more than just the purchase price. Firstly, you've got the initial cost of your deposit, and you've also got a hefty 5% stamp duty surcharge in England and Northern Ireland. There are slightly different charges in Wales and Scotland. On screen is an article from the Money to Masses website on everything you need to know about stamp duty. In here it tells you the different stamp duty rates that are payable, but the main thing to point out, if you are buying a second property, there are additional rates. So you can see you can end up paying at least 5% as a minimum stamp duty on a property, up to 17%. There is also a really useful stamp duty calculator on the Money Helper website, where you can go through and actually calculate the amount of stamp duty you could potentially have to pay on any property that you want to buy. Other initial costs include solicitor fees, survey fees, and mortgage arrangement fees. Then that brings us on to letting costs. That's the cost just to get your first tenant in the door. So you've got to think about cleaning, repairs, furnishing, advertising, and all the mandatory safety certificates. And finally, you've got the ongoing running costs. This is your mortgage cost, insurance, any service charges or ground rent, and a budget for maintenance. So assuming you've calculated all those costs, how are you going to pay for the property? Unless you're a cash buyer, you're going to need a specialist buy-to-let mortgage. Right now, most lenders will demand a deposit of at least 25% of the purchase price, although some will go as low as 20%. But one of the most important numbers is the rental coverage. Lenders will usually require your expected monthly rent to be between 130% and 150% of your monthly mortgage payment. They need to see a significant buffer to know the investment can cover its own costs and still be profitable. If you want to see what kind of mortgage rates you can get on a buy-to-let, then there is an article on the Money to the Masses website which looks at the best mortgage rates in the UK. And if you go to the bottom of the article, we also cover buy-to-let mortgages as well. So you can see on screen here some of the best 2-year fixed rate buy-to-let mortgage deals are around 1.69% based on the loan to value being 60%. Then it moves up to around 2.84%. You've got to be mindful of those lender fees as they are quite significant. So I'll put a link to that in the notes. You can find out more information, and it is based on certain assumptions as listed underneath the tables of there being a purchase price of £350,000 for a term of 25 years and on an interest-only basis. As well as fixed-rate deals, there are, of course, tracker deals as well. And that brings me on to your potential returns. Now, when it comes to rental yields, the number you'll hear most of all is gross yield. That simply means the annual rent divided by the purchase price. But the number that actually matters really is the net yield. That's the rent after you've deducted every single one of your costs, like the mortgage, insurance, repairs, taxes, and void periods. Your net yield is your true profit. It will be significantly lower than the gross figure. Now, according to a recent report from Zoopla, the average gross yield in the UK is around about 5.6%. And I'm showing the details on screen here, but you can look at it by city as well as region. So Sunderland actually had the highest gross rental yield of 8.96%. Now that gives you an idea, and if you go down you can look through various different cities across the UK, and what you start to see is there's definitely a bit of a north-south divide. If you look at the regions, the northeast has the highest average gross rental yield of 7.65%, then it's Scotland at 7.48%, then it's the north west at 6.66%, and we go all the way down until we get to the southeast at 5.34%, the east of England at 5.28%, and London at 4.93%. Now, that does give you some ideas of average monthly rents and the average price to buy a buy-to-let property. And as I mentioned at the top of the piece, while you may not have had the capital growth in somewhere like the northeast, you have had a much better gross rental yield. What the report highlights is that there is definite opportunity for people to own buy-to-lets in parts of the country other than where they live, but they need to really understand that local market before they get involved. Another thing that trips up a lot of new landlords is tax. The rules are relatively complex and they've become less generous in recent years. Rental income is subject to income tax at an individual's tax banding of 20, 40 or 45%, and it's declared via self-assessment. This is assuming that you own the properties personally. Significantly, there was a change in April 2020 that restricted the mortgage interest rate relief that you receive. So landlords can no longer deduct the full amount of their mortgage interest from their rental income. Instead, they receive a tax credit equivalent to 20% of their interest costs. This has made buying through a limited company called a special purpose vehicle, or SPV, a more popular strategy. I'm not going to go into that in this video, but it's something that you might want to look into. The advantages of an SPV include the ability to deduct 100% of mortgage interest costs and paying corporation tax, which is often lower than higher rates of income tax. Disadvantages include higher mortgage costs, increased administration, and the potential for double taxation when drawing money from the company. But if you've got a decent accountant, they can help you with that. I've already mentioned stamp duty, land tax, but when it comes to selling, capital gains tax is levied on the profit above your £3,000 annual allowance. The rate of CGT that you pay is 18% for basic rate taxpayers and 24% for higher rate taxpayers, and it's payable within 60 days of completion. I'll put a link to a capital gains tax calculator in the notes of this video so you can go and play with that to see the kind of tax that you might potentially have to pay, but you can offset certain costs when you do sell a property to reduce your tax bill, and that includes the stamp duty that you paid when you initially bought the property. Moving on from tax, landlords have to adhere to very strict legal responsibilities. Mandatory safety standards include an electrical inspection every 5 years, an annual inspection by a gas safe registered engineer for all gas appliances, smoke alarms on each floor, and carbon monoxide alarms in any room with a solid fuel burning appliance. There are lots of rules you have to adhere to. I'll put a link in the notes so you can read it at your own leisure, because again, I'm not going to go through it all here. But landlords in England must also conduct right to rent checks to verify the immigration status of all their tenants over the age of 18. There are stiff penalties for non-compliance. There is also the minimum energy efficiency standards that you have to bear in mind, and you have to have an energy performance certificate or EPC rating of E or higher, and that's predicted to change in the future, possibly increase to a minimum of C by 2030. Then we've got houses in multiple occupation, or known as HMOs. The license is required if the property is occupied by 5 or more persons. Managing an unlicensed HMO is a criminal offence and can result in a fine. But finally, there is a significant legislative change that's imminent, and it's called the Renters' Right Bill. Now, this legislation is currently nearing the conclusion of its passage through Parliament and is anticipated to receive royal assent in September or October 2025. And its most impactful provision is the abolition of Section 21 no-fault evictions, meaning landlords will no longer be able to terminate tenancies without specifying a valid reason under the Section 8 grounds. Now, this increases the risks associated with a tenancy and necessitates more stringent tenant screening. So it's something that landlords now have to bear in mind if they want to get involved in buy-to-lets. The bill also mandates a transition to periodic month-to-month tenancies. So that means we're going to get rid of fixed-term tenancy agreements. It introduces new grounds for possession, but also revises notice periods, such as a doubling of the notice periods for rent arrears to 4 weeks. The rent increases will be permitted only once per year, and they must be aligned with the current market rate and can be challenged by the tenant at the first tier tribunal. Furthermore, the bill will ban blanket discrimination against tenants with children or those receiving benefits, and will grant tenants the right to request to keep pets. To enforce these changes, a single mandatory private rented sector ombudsman will likely be introduced, along with a new property portal where all landlords must register their properties. While the bill is expected to become law later in 2025, the full implementation of the Section 21 ban might not occur until early 2026. So after all of that, what's the bottom line? Well, buy-to-let isn't a passive armchair investment. In fact, I don't think it ever really was. It has become an active, highly regulated business, and it demands significant capital, professional level diligence, and constant eye on the ever-changing legal and tax environment. You should seek the advice of existing landlords, as I've mentioned a number of times, and if I'm honest, I think there are far easier ways of making money from investing. So if you found that useful, do make sure you hit that like button, but also subscribe to the channel. If you're a landlord, please do leave all your experiences and expertise and comments to help other people in the comment section of this video.